What are the benefits of global exposure in a utilities portfolio?
I think the diversification argument is actually even greater in the utility space, and I think that's key for two reasons. The first being you really reduce down your catastrophe risk. If you think about these assets, they're fixed in place assets, but the business model is the same no matter where you are globally. And so by diversifying out geographically, you really are minimizing your exposure to natural disasters in any one place, be it U.S. wildfires or Canadian ice storms or what have you. And so you really reduce down that risk there. I think the second key area is you flatten out your concentration to regulatory risks. And what I mean by that, and I think that's really important right now, is we have a lot of talk about the U.S. administration and their economic war on Canada, as well as political uncertainty here. We have a leadership change and potential elections upcoming. I think that's really key for investors to really look at their regulatory risks. And instead of trying to pick your best exposure in Canada, you really want to branch out into the US, have exposure into multiple states where some areas are more favorable regulatory-wise in the US, and then extend that out into Europe as well and take that a step further and have really flatten out and broaden your exposure into regulatory risks. And I think that's very important for heavily regulated assets.
How have global utilities fared versus Canadian-only utilities?
The global utilities market has performed quite well versus the Canadian utilities market, where we're seeing a little bit of underperformance. I think there's kind of two key areas to focus in on here. First is that HUTL, our Global Utilities Fund, is focused more on the regulated traditional transmission and distribution assets, as well as the big integrated utilities names. Whereas if we look at the Canadian market, especially one of the popular Canadian utilities indices, it has about 10% exposure to the renewable energy companies, which are down about 5% year to date, and it has about 10% exposure to the dedicated power generation names, which are down about 20% year to date. And I think there's a few things driving that underperformance. First, on the renewable side, it's really being hampered by the Trump administration stance on fossil fuels, and that's really driving sentiment down. But also on the sentiment side, the talk about renewed tariffs and a trade war and the threats and how far that goes. We've had talk about Doug Ford cutting off energy into the U.S. And so that's really weighed on sentiment in the sector. And I think also, finally, you have sort of the headline risks, for the AI growth story and how that impacts on power demand. And, specifically, we've seen DeepSeek news come out about their AI models being a lot more energy efficient and how that impacts on power generation companies. I think for now it's a little bit low confidence on that story, but it is nonetheless weighing on sentiment. I think the other area is the telecoms space. That we've seen a big boost in that market, but that's been outside of Canada. The Canadian telecom companies, have been undergoing a little bit of slowing growth here, higher debt levels, rising interest costs, whereas the European and U.S. names have really been probably the best performing subsector in our universe. They've seen much better pricing, revenue growth, and much better margins. And so I think that really points to the benefit of having a geographic and a subsector diversification approach to utilities.
Subscribe to Harvest ETF's Insights. Join us and stay informed.